Hello and welcome to Fireside with VC. My name is Andrew Romans and I'm very excited to have Victoria Cheng on the podcast. Victoria, great to see you.
Hey, Andrew. Nice to see you too.
So Victoria and I go back to when she was at Citi Ventures, so the strategic investment arm of Citibank. So she definitely knows her way around fintech. And she, I guess, joined one of her colleagues who was co-running it to set up PruVen Capital, which is a newly minted $300 million multi-stage VC
Yep.
fund. And I'll let Victoria explain the sectors, but they're going after big industries or people disrupting big industries, including fintech and insurtech for sure. Victoria also is passionate about her work with women in tech through her position at Women in VC and Money 2020's Rise Up. She's also been kind enough to join VC panels of events we've done when we launched our CVC book in San Francisco, as well as your colleague Luis in New York. But Victoria, great to see you. And maybe start by telling us about the genesis of this, first time $300 million fund with Pru. And maybe before even saying that, for those that are not from Earth, who never heard of Prudential Financial, they have $1.6 trillion of AUM. It is the largest insurance company, insurer in the United States. Is it the third largest real estate investor in the US? Is that right?
So
That's
it's their largest real estate investor. It's a little known fact.
Yeah, it's a little known fact that I didn't know, but it's a big fact. And then they support employers in 40 different countries. So it's a truly global reach company. So I'm curious to hear about the genesis of this and see how we can all work with you.
Yeah, and maybe I'll start off with, what do we invest in, right? So um, we built this in partnership with Prudential, and the idea was to provide our companies with unique access post investment to the expertise and resources of what is a global financial institution, right? So as a result of like all of those capabilities and the backgrounds of us as partners, we invest in fintech, insurtech, digital health, real estate, and enterprise IT startups. We focus largely on the US, but we do have a global mandate. So that includes LATAM, it includes Europe, it includes Asia. And we're mostly investing in, post-product development companies they're in market, they have clients, and they're really looking to accelerate their growth, right? Scale the company. And, we're looking at most of the time companies that are Series A to Series D for that initial investment. But we can support companies all the way to IPO and beyond. As far as the genesis of PruVen, I joined in September 2020. So alongside my partners, but Ravnika Travis, both from Citi Ventures, we're super excited to build out this platform. It was ultimately a culmination of our experiences at traditional VC firms and also at Citi, which is a strategic investor. And the idea was, how do we bring to startups value that is beyond the four walls of our partnership, right? If we are going to be an independent VC. And how do we bring really differentiated value to those companies and bring them, these opportunities that otherwise are more difficult to have access to? And so all of those components are built into the structure of our fund, right? So, we wanted to have this like freedom to act in the way in which we operate the fund, like a traditional VC would. But then, like once you've done that, like what else can you do to help those companies create value? And that's where our partner and our LP, like Prudential, comes in, right? And I think it is a very unique structure and a very unique relationship that we are building with Prudential.
And as far as stage, so it just occurred to me seeing your background, I was thinking PruVen, but it's also proven. Like, is it proven to work before you pick them up? I mean,
That's the play on words.
yeah, it's cool. Series A is a little bit of what Series B used to be in the ancient times of the 1990s when I was a founder raising venture capital funding. But what typical revenue, do you market by revenue or traction? Like, when would you first get involved with a company? Is there
Yeah.
an MRR, an ARR, or some other definition?
Yeah, so we're looking at companies that can be anything from like, hey, we've got like this product, we've got some initial customers, maybe we've got about $1 million worth of like ARR, and we've
Okay.
kind of tested it out in the market, and it seems to be working, right? And so how do we start to really blow out like go to market? How do we really start to get into larger enterprises? How do we think about pricing and all of that kind of stuff? But the tech itself has been built. The product is out in the market. There are some folks that have been using it and they like it enough to pay for it, right? So that's really
Right.
what we're looking for.
Right. So it's a little bit proven,
Yeah.
And so geographies, I guess you're open-minded, and people are all over the place with COVID anyway. But what would your primary markets be geographically?
Yeah, so our team is based here in the US. So most of our investments are likely, at least for the foreseeable future until we travel again here, going to be in the US. We do have, Prudential, in addition to being the largest life insurer in the US, is also a massive life insurer out in Asia, right? And so we do think about, what other areas could we be investing in where we're seeing the same kind of like transformations, right? Digital and data transformations when it comes to all of those large industries, right? Some of the largest industries in the global economy, right? So from that perspective, like we are looking at outside the US, but I expect for the near term, many of the investments we make will be based here.
And I've spoken to a lot of CVCs about what they like, what they want to change, and I think CVC is an evolving thing, so it's not hopefully static forever. It changes. But do you guys have outside people from Pru on the IC, on the investment committee, or is that something that's from the get-go in-house? Because there's advantages, there's pluses and minuses of doing it both ways, I think, for sure.
Yeah. I mean, there's a spectrum when you talk about CVCs, right? And it really depends on what what your larger corporate is looking to get out of it, and also, what you're trying to accomplish as like the investors within the fund. So we often get asked like, are we a CVC? Are we an independent VC? And honestly, we're an independent yet integrated model. And so what that means is that we're independent in our decision making. We are independent in the way in which we run our fund, but we are integrated in the ability to add value through Prudential, right? And so the idea of PruVen was meant to take the best of both being a traditional VC and a strategic VC. And all of us, so all three of us as partners, came from a traditional VC and went to a strategic VC. And then this is really the evolution of those experiences, right? And I think there are, the reason we were very careful around like having this kind of structure, and it really comes down to, there are things that you can accomplish when you're looking at alignment of interest in this model that can be more difficult than other models, right? It just depends on like what the purpose is. And so from the startup perspective, there's always this question of like, hey, are you aligned with the incentives for me as a founder, right? And for us, like, information shared with us like stays with PruVen, right? We are aligned economically with our founders to see them be extraordinarily successful. And then on the other hand, we're not just a check, right? We also, from the perspective of being integrated, have the ability to leverage Prudential, who has committed more than just capital to us, right? They've committed these full-time resources that engage with us at senior levels of the company to drive like startup partnerships, to drive innovation, to actually provide some feedback, resources, expertise to the companies that we invest in. And I think that's pretty powerful.
And Prudential is a anchor LP, but they're not a sole LP, right? So you have a diversified LP base with this first fund?
So Prudential is actually, Prudential is actually our sole LP. So they are 100% of the capital in this fund. And I think it's very important for us to get the foundations right for the type of platform that we're building. So you need to have a ton of collaboration, infrastructure, processes, operations. You're building like the API between like yourself and this massive organization, right? Ultimately, in the long run, we may bring on, and we are thinking right now of bringing on additional LPs into our future funds so that we can leverage this operating model that we've created to support, our companies in increasingly differentiated ways, right? So I think that's the idea, is like, how do we take this IP that we're building in working very integrated with like a particular LP of ours, and then bring that into other LPs in the future.
Well, even when you guys were purely independent financial VCs and then at Citi Ventures, you get to know some of your LPs and figure out, can I API my way into that LP to connect them with a startup and something good happens, right? Are you doing anything differently that is not classic standard, or is there stuff you've learned from Citi Ventures that other people can learn with? Like Salesforce Ventures even has a team that if Salesforce Ventures decides not to invest, this team is trying to kind of open innovation, the startup into the organization anyway. Like, have you come up with, are there any specifics around the API of how you connect PruVen Capital into the myriad of BUs within Pru?
Yeah, so there's a ton of work that we have done. So I'm trying to figure out where to start. I think a lot of learning. So a lot of things went really, really well at Citi, and I think, one of the big learnings was the ability for a VC, right, to make an introduction to a startup can be very powerful. It's part of the reason that you take capital from like a institutional VC to begin with, right? It's, hey, you have a network, you have experience that I don't have, that I would love to tap into. And I think what I saw over time was that making the introduction is actually the easiest part of building a partnership, right? And going from that introduction to building a partnership was where I spent a vast majority of my time at Citi in supporting those portfolio companies. So it really is a full-time job.
Yeah.
So I think that whatever you can do to help facilitate that process of identifying and filtering through, prioritizing companies, and also helping to position those companies in ways that are important to the priorities of a larger organization, or identifying what those opportunities might be, that takes it one step further than just, hey, this is something really interesting, you guys connect and maybe something comes out of it, right? So really shaping what that conversation could look like with ideas of what is possible. And then how do you actually go from there to a full, partnership, whatever that partnership might look like, right? And it could be as light touch as, hey, somebody within Pru would love to be an advisor to the company, and the company is really looking for someone with that expertise, right? To all the way to, hey, co-creation of new products, distribution of, your startup's products, or the startup becoming a vendor, right? Or entering into new markets together. So it runs the gambit what you can do together. But I think that process is not an easy one. It actually takes a ton of resources to do.
Yeah.
And we're thinking around, how do we create operational leverage around that with technology, right? So not just with people, but also with technology. And from that perspective, that's a lot of the work that we're doing right now.
Yeah, I think there's naturally some pushback from the heads of BUs to not want to work with an early stage startup. It's like, you don't get fired with with Big Blue IBM mainframe when it was 3 times the price and half as good as a DEC mainframe. People still went with IBM, right?
Yep.
Have you, at Citi, and I know things are just very, very new. I mean, when you started investing in December?
That's right. We launched in December.
Right.
We invested in a couple of companies before that, but we launched in December.
Okay. So how do you address these challenges of trying to move at startup speed and even get someone who's maybe not financially motivated to, work with a startup? Or do you find these days there's a real mandate that they're trying to make real, and so they jump at the opportunity? What's your experience there?
Yeah, I think that two things. One is, yes, there is a mandate more from the top, from the C-suite, right? That's where we're sponsored and we are, from the general account, right? So there definitely is that importance of how quickly technology is moving, how important it is to actually be driving innovation. And perhaps you're right, you don't get fired for hiring IBM, but the question is, do you win in a very competitive market as things develop over time? And if the question to that is you might not, and if your competitor is creating new products and being better at, customer acquisition or digital engagement, et cetera, then how do you defend the clients that you do have, in addition to how do you win more market share, right? And I think those questions, as you think about long-term growth for a corporate entity, like that's where startup innovation can come in, right, and really support.
I mean, you're preaching to the choir, of course, but every time we talk, something like that. But that's exactly what I want to talk about is, so what are the biggest issues facing corporates in these other large markets you're addressing? And like, what technologies do you see startups that are working on that are really must have for these large corporations? So it's kind of interesting. If the corporates do not adopt some of these things, there's offense and defense, but they're at risk of really big in trouble if they're the last to adopt certain things. But what changes are you seeing at the corporate level, and what is exciting you the most within the startup world? I realize that's a very general question, and you cover more than just fintech and insurtech these days.
Yeah, so I think on the enterprise side, it's been fascinating, right? I mean, COVID has accelerated the adoption of technology across consumer enterprises in ways that we've never seen before. Like companies that thought, hey, we need a 5-year roadmap to enable remote work. And, yes, we're going to bring this transformation of automation to our customers, and we're going to have like a digital interface for everyone. But it's gonna take time. We've got to go through the whole process, right? I mean, suddenly they were forced to do it overnight, right? And that, I think, has catalyzed this amazing transformation of multiple industries, right? And the industries that we're invested in obviously are the ones that we think are going through that, right? So if you think about financial services or insurance or even, healthcare for sure, right? Real estate, like you're seeing the adoption of these capabilities at a much faster pace. So I think that's sort of like one thing that's really exciting, right?
And even at the level of because you got the perspective of the corporate and the startup here, with a lot of our portfolio companies, you could see that COVID was like a 5-year accelerant on let's stop talking about this and let's start doing it. And then at the same time, there was some challenges of like, well, COVID has really screwed up everything here. This is getting pushed back to next year before we buy the company, at least. So there's a certain level of accelerant and then a certain level of let's push things back a few more weeks or a few more months, which can elongate a sales cycle. What is your perspective? Are you not seeing the elongation?
Yeah, I think it depends on the product.
Yeah.
Right. I think for some products, it has definitely accelerated, and for other products, it may have been pushed back, right? But in general, I feel like most of the tech-enabled products have actually accelerated, right? So, okay, you need to do like remote sales, like, you need to, within the healthcare space, we've been spending a ton of time around, right? It's the idea of like telemedicine, remote care, mental health, like all of that has certainly accelerated, right? I think the adoption of, even the adoption of machine learning within like healthcare, right? So I'm an investor in a company called Data Robot, and they got pulled into healthcare with like exponential force, right? Because we need to understand like where is COVID, where is it spreading, how will it be impacting like populations, right? So I think that like, yes, it depends on the industry, but more than not, I am seeing this be beneficial for many companies. Now, it's true that the sales cycles for some things may take longer, but the sales cycles for other things are also shortening pretty dramatically, right? And the last thing I would mention is that I think at least in healthcare, we're seeing COVID highlight the importance of investing in like the infrastructure inside of healthcare, right?
Mm-hmm.
And so I think in addition to accelerating adoption that would have already been on the roadmap, it's also highlighted where do we need to invest where we historically haven't been thinking about investing, right?
Sure. And so how are things changed for you? I know a lot of VCs were saying, I need to look someone in the eyes I jokingly say like Larry David before I can make an investment. And then people realized you better invest over Zoom or, you're not active. Um, have you guys just fully transformed to investing kind of over the internet, or are you primarily focused on people that, I had a friend tell me, he's like, what kind of VC are you if you don't already have a relationship with most of these entrepreneurs? What's your, how are you guys getting along with doing things virtually?
Yeah, I think that's a little bit extreme in that, in the beginning, I would say for most VCs, they were working through their pipeline, right? There were companies that, if you were a Series B investor, you'd met all the Series seed companies and Series A companies, and you were kind of investing in folks that you knew, but the deal itself might have been remote, right?
Right.
And I think now you're starting to see like that pipeline transition, because it's been a year almost since we've
Yeah.
had COVID and quarantines and lockdowns, right? And you're seeing that pipeline transition to, hey, I'm meeting actually new companies, right? And getting to know those companies over Zoom remotely. I think that the time that is spent is a lot more around, okay, how do we validate? How do we do references? How do we get a lot more data points around a particular individual or a particular industry that you might have been able to suss out differently, like with more in-person interactions. But I think that like uh, as things go forward, what is exciting is the friction in getting to know firms in that first like interaction, right? Before you felt like, hey, like I have to go and like visit like this person, right? To meet them in person for like a first meeting, or like, you feel like you as a founder have to like go and travel to like go see all the VCs on Sand Hill Road. Like, and now I think there's much more willingness to just hop on a Zoom and like do that like that first interaction, right? So you
Right.
get the ability to meet a lot more people and a lot more founders and a lot more VCs, like before you like dive into that in-person meeting, right? I think that's going to be more of the norm, and certainly more of the norm if everybody keeps leaving the big centers.
Yeah, yeah. I mean, so there's a departure from the super cities for all kinds of reasons. There's culturally too. For me, we've raised a lot of money outside the United States, and a lot of these cultures really don't use the telephone or Zoom and really rely on face to face.
Hmm.
And I think that that continues to be the case, but just like you said, they're willing to say, let's do a first round Zoom before trying to jump on a 12-hour flight here. And so you're saving yourself all that 12-hour flight before and after, not to mention jet lag, by at least saying, do we have enough going on here to, take the effort to meet in person? And so it's way more efficient. It's a way more efficient world, I think. That's interesting. So, talking about valuations and exits, what has been your sense? Well, to us, it was nothing like 2001 or 2008, post. But what is your experience on valuations of startups raising during this pandemic as opposed to before?
Hmm. Uh, so I think that it depends on the startup, depends on the industry, depends on when during the pandemic you're talking about. For a lot of startups that were raising in April of 2020, it was not an easy time, right? They saw the impact of the uncertainty of what was going to happen because of COVID.
Yeah, yeah,
And investors, they may have closed those rounds, but they may have had to elongate the process, right? You thought it was going to take like 3 weeks and to the end, and you now all of a sudden had an extra like 3 weeks or 6 weeks, or the investors were coming back and saying like, hey, like the outlook has changed, right? Um, but I think since then, we've seen people, especially with the promise of the vaccine getting distributed, us being much more effective in treatment of COVID. Like I think now at this point, investors are getting more and more confidence in in putting dollars to work into companies. And certainly, I think from the from the institutional LP perspective, like there's low yields like around the world, and so the stock markets, if you've been watching them, they're at like all-time highs, and funds are still raising tons of capital, and there's more SPACs than I think like in the history of SPACs. So there's the valuations of the companies, I think, if you look back at like what deals were being done, may have dropped a little bit in the early times of COVID, but at this point, feels like they are certainly coming back to the levels that they were at before.
Sometimes you see conviction on the investor side and confidence on the founder side with all this uncertainty. And I think we went through a moment where everyone was freaked out by the uncertainty. And it was like, look, let's not be picky. Let's just fund the company for 24 months, or let's extend the runway. And so where you were saying it could take an extra couple of weeks, it was almost happening faster because the founder was saying, look, I want to extend my runway during this uncertainty. And as you see vaccines come, even the election almost blowing over by now, there's less of that uncertainty. We seem to have some certainty that populations will be vaccinated, and the founders are not willing to sell equity cheaply just to bridge through some endless lockdown. So, and people are doing stuff. Well, listen, that's great. I'm really excited to meet the rest of the team and start working with you guys, and let us know if we can be supportive. And I guess when we see companies hitting into the Series A territory, that'll be the first ones we show you.
Yeah, I mean, we have a lot of capital to deploy into supporting great founders. So look forward to working together.
Okay, great to see you, Victoria. Thanks so much for coming on.
Take care.
Bye.